about this basics of private trust. What is the concept? How do you create it? What is the care what we need to take? We'll talk a bit about the Indian trust law. We'll talk a bit about the Income Tax Act. We'll talk a bit about FEMA, especially where you have non-resident family members, non-resident trustees. And we'll also talk a bit about SEBI. What if, let's say, you are a promoter of a listed company? We'll keep the case studies, we'll keep the discussion simple and more practical without getting into a lot of technicality. And what I've already agreed with Mehul and Sachin is that if you have questions, it's a small group. I'm very happy. In fact, I enjoy more talking with a smaller group, because it's more interactive. So I think feel free to interrupt me in between pose questions. So I think we can make it interactive for the next 90 minutes. With this, let me jump to the first slide. And I think this is very important, to understand what is a trust. And let me give you a couple of examples. When we form a company, a corporate entity is a separate legal entity. When we form an LLP is a separate legal entity. Even if you look at the Income Tax Act, Section 2, subsection 31 defines what an assessee is. It says an assessee is an individual, an HUF, a LLP, a firm, a company, a AOP, but you never see the word trust there, right? So the question is, what is this trust? Is it a legal body? Is it a registration? Is it a fiction of law? And the simple answer is that a trust is not a legal person. That's a very important concept, because all the tax implications follow the foundation that a trust is not a separate entity like a corporate entity, like an LLP, etc. And that is one of the key reasons why you do not find the word trust under the list of assessees under Section 2, subsection 31. See, if you were to look at the Indian Trust Act, it's an interesting definition. And maybe I'll also give a practical example just to bring home the point. It says that trust is nothing but an obligation annexed to the ownership of the property, arising out of a confidence reposed in and accepted by the owner or declared and accepted by him for the benefit of another or of another and the owner. Such a complicated definition, It simply means that there is a person who has a property. That person gives that property to somebody else. The person who receives the property promises him that I will utilize this property for the benefit of again somebody else. This is all what this definition wants to say. So, let us say I have this, Income Tax Act book, right? And I want to create a trust today while speaking with all of you. I am the owner of this property. I, let's say, make Mehul as the trustee. So I tell Mehul, I have a property. It's a very valuable property. People can get knowledge from this book. So I am going to transfer the ownership of this Income Tax Act to Mehul. And Mehul has to ensure that this book is used for the benefit of all the people who are kind of participating today. So all of you become beneficiaries. Because I have created that trust. I am the settler. I am the creator. Mehul says, I'll take the responsibility of the property, what you have created. So he becomes what we call the trustee. And all of you become beneficiaries. And by uttering these words, I've actually created an oral trust. So it's not necessary that I need to create everything in writing. Even an utterance creates some kind of a trust. So this is the concept of a trust, that trust is not like a registered body. Trust is not having any separate legal entity. Trust simply means that the settler evokes a promise from the trustee that I'm transferring certain assets to you, and you please ensure that this property is used for the benefit of the beneficiaries. As simple as that. And therefore, if you look at it, there are three players: the settler, which in my example was myself, the beneficiary, which is all of you, and the trustee, where we made Mehul, as the trustee about it. I hope this is as simple as that, And this Income Tax Act is nothing but the trust fund. It's the trust property. And I can keep on enriching the trust by putting in more books, etc. So, you can always keep on, funneling the trust pool by putting in more and more property. So this is basically the concept, I would say, of a trust. Let us, just a minute, let us go one by one. So let's look at the settler. So who can be a settler? Any person who is competent to contract can be a settler. As simple as that. What is the role of a settler, or what is the role of a creator of a trust? Uh, unless the settler is creating a revocable transfer, and I'll come to it. A revocable transfer would mean that I am telling Mehul that, hey, I am giving you the book, but I can take it back tomorrow if I want, which means I have not permanently transferred that book to Mehul, which means I have not permanently created a trust. I have actually created a revocable trust. Most of the trusts in the country are irrevocable, where the settler permanently parts away with the property to the trustee, and there is no way the settler can take it back. In case of an irrevocable trust, the role of the settler ends. He actually has no further role. The role of the trustee starts. But in case of a revocable trust, the settler typically will retain certain powers, the main power being of taking back that property. So in the example in which I gave, if I were to tell Mehul that, Mehul, I can take this book anytime, right? The trust is a revocable trust. Or if I tell Mehul that anytime in the first year I can take that book, then for the first year, the trust is a revocable trust. And from subsequent year, the trust becomes an irrevocable trust. This is the concept under the Indian Trust Act. The concept of a revocable trust under the income tax law is very different. We'll come to it. But today we are talking about general principles. Uh, uh, See, once I create a trust, once I settle this trust with this book, tomorrow, let's say Sachin wants to put some books, tomorrow Amay wants to put some books, Sharad Bhai wants to put some books in that same trust, they can do it. So it's not necessary that it's only the original settler who needs to put his funds into the trust. You can have new people coming and putting those properties into that trust, and that's perfectly fine. The next question is that, can a settler be the beneficiary? So can I tell Mehul that, Mehul, by the way, even I am one of the beneficiaries. Even I have the right to use the books like all of you. Answer is yes. Absolutely, the settler can be the beneficiary. The only condition is that the settler cannot be the only beneficiary. That kind of a trust is illegal. I cannot tell Mehul that keep this book and I am the only beneficiary. That's not a legal trust at all. There has to be more than one beneficiary. The next question is, can I become the trustee? So instead of I appointing Mehul as the trustee, can I, as the creator, as the author, as the settler of the trust, says, let me only become the trustee, me only take care of this trust fund, which is an income tax act, and me only administer it for the benefit of all the beneficiaries? Absolutely possible. But it can't happen that I am the settler, I am the trustee, and I am the sole beneficiary. You can't have a single person having three roles. That's an illegal trust per se. So this is broadly what I would say a settler is. Now, let's look at what a trustee is. And of course, in most cases, the role of a trustee is the most important, because most of the times you will give maximum power to a trustee. Again, a trustee can be a legal person, which means I can form a company which acts as a trustee, or I can have natural persons, individuals can act as trustees, or there can be a combination of trustee companies and individuals who act as trustees. Obviously, those entities should be competent to contract. Who is the legal owner of the property? It is actually the trustee. So, as I mentioned, trust is not a legal person. So, how does the trust hold the property? Through the trustee? How does the trust make contracts? Through the trustee? How does the trust sue some other party? Through the trustee? So basically, it's the trustee which is kind of guiding the trust. Are there any restriction on any number of trustees? The answer is no. There are no restriction on any number of trustees. Of course, the only exception is where a trust involves receipt and custody of money, right? That's all what it does. Then the law says that, see, it's an important role because your role is really to take care of the money. In that case, you have to have a minimum of 2 trustees. And when you create a private trust, even a single trustee is perfectly fine. And I want to clarify here that a private trust and a charitable trust, they are both governed under the Indian Trust Act. Only difference is a charitable trust has a regulator. So in the state of Maharashtra, we have the Bombay Public Trust Act applicable to a charitable trust. However, a private trust has no regulator. So if I create a private trust for my family, for my friends, I don't need to register that trust anywhere. Registration is optional. Nobody, in fact, registers it. 99% of the private trusts never get registered. And there is no regulator involved. I don't need to answer to anybody. I just need to file my income tax returns, etc. That is all what I need to do. Can a trustee also be a beneficiary? The way we discussed, can a settler be a beneficiary? Absolutely. Even a trustee can be a beneficiary. Now, it's very interesting. Is a non-resident trustee permissible? And what I want to do it is, any aspects of non-resident, I'm taking it up in a separate slide. So let me answer when we come to that tema. That's a very interesting area where the law seems to be different and the current practice seems to be different. And can I appoint more than one trustee? So let's say in my example, can I and Mehul become co-trustees? Answer is yes. Then can I do what I want or can Mehul do what he wants? Answer is no, unless the trust deed allows it. Because if there are multiple trustees, then we have to decide jointly, unless the trust deed gives any special powers to any one of the trustees. So this is a broad concept of the second player, which is trustee. Now let's come to what do you mean by beneficiary, and of course the Indian Trust Act, the ITA here refers to the Indian Trust Act, not the Income Tax Act. The Indian Trust Act does not define a beneficiary. It defines the term beneficial interest, and it says the beneficial interest is a right against the trustee who is owner of the trust property, which is very logical. So if I and Mehul are trustees and we are holding this Income Tax Act, which is the trust fund, which is the trust property, and all of you are beneficiaries, then your beneficial interest is the right against us to use this trust property. Are there any restrictions on the number of beneficiaries? There are no restrictions. You may have one beneficiary, you may have 100 beneficiaries, you may have 1,000 beneficiaries. Obviously, when you have public as the beneficiary, this no longer remains a private trust. When you have selected individuals as beneficiaries, then it becomes a private trust. Who can be a beneficiary? Anybody can be a beneficiary. You can have actually a non-individual, a non-natural person become a beneficiary. You can have a minor become a beneficiary. You can have a person with mental disability become a beneficiary. You can have another trust becoming a beneficiary. There used to be a controversy. Can a trust become a beneficiary of another trust? Answer is yes. So anybody can be a beneficiary. And unlike the requirement for a settler and a trustee that they have to be competent to contract because they have responsibilities, a beneficiary has no responsibility. The only role of a beneficiary is to enjoy the benefit, and therefore you need not be competent to contract. Anybody can basically play the role of a beneficiary. I think with this, we'll just summarize. As I said, the role of a settler. Once the trust gets created, generally the settler steps back. There is no further role of the settler. Duties and powers of the trustees, almost everything. They are like the board of directors. They can do whatever they want under the charter of the trust, depending on what the trust deed has provided. And entitlements to the beneficiaries, obviously, it is to enjoy the trust property. It is to hold the trustee responsible to follow the trust deed. It is to expect some distribution. Obviously, in case of a discretionary trust, it is all to the discretion of the trustee. But that is the limited role of the beneficiary. So as you would see, the key powers are always vesting with the trustee. Now, let's talk about some general concepts, and it's about the types of trust. Suppose I create a trust and I have my family members and I give everybody equal share. Let's say I have, my mother, my wife, my daughter, and I say 1/3 share to each of them. Then I'm creating a specific trust because I am allocating a specific interest to each of the beneficiaries. But let us say, instead of saying each beneficiary has 1/3, I say that I do not want to specify what they get. They are all beneficiaries, but I as a trustee would decide every year what distributions to make them. In 1 year, I will give 1% to somebody, 30% to somebody, and balance 80% to somebody. It's my discretion. In another year, I would change it to 10, 20, 30. In third year, I would make it 50-50. It's absolutely me as a trustee who would decide that. Then that trust is normally called as a discretionary trust. Same way, what is a revocable trust and what is an irrevocable trust? As I mentioned, if a settler says that, hey, Mehul, I'm giving you the property, but I can take it back anytime, it's a revocable trust. But if a settler says, I'm permanently parting that, and once I part that, I have no role, the trustee has to now use that property for the benefit of the beneficiary, there is an irrevocable trust. right? And I hope the concepts are, pretty clear. And in our country, I would say almost 98% of the trusts would be irrevocable trusts. Nobody creates revocable trust unless there are certain specific objectives. Uh, what's a testamentary trust and what's a non-testamentary trust? The concepts are very simple. I can actually create a trust under a will, which means I create a will. Under the will, I write all the relevant clauses of the trustee, and I say that this gets into effect after my demise. That's a testamentary trust. And if I create a trust during my lifetime, it's a non-testamentary trust. Again, I would say in the country, majority of the trusts would be non-testamentary trust. Very few people use the wills to create a trust. What's an oral trust? I just created an oral trust today, by donating my income tax act. I know the budget is around the corner, so the income tax act has no utility. It's of the previous finance act, but I just created an oral trust by uttering words. But what if I put it into a deed where I write those clauses, where I draft those clauses? Then it becomes a written trust. And again, from a pure taxation perspective, it doesn't matter whether something is an oral trust or something is a written trust. From a pure legal perspective, it doesn't matter whether something is an oral trust or something is a written trust. The trust has a validity. Obviously, for obvious reasons, you need to have a written trust. That's always better for you. Why don't we very quickly discuss about what's a discretionary trust? And the reason is most people create discretionary trust. That's also one of the best ways to have some defense against a future estate duty. So we'll very quickly go through, some features of a discretionary trust. As I mentioned, the first and most important feature is that the shares of beneficiaries are not defined in a discretionary trust, right? They're absolutely silent. It is to the discretion of the trustee whom do they want to give how much, and that can keep on changing year after year. The second important feature of a discretionary trust is that a beneficiary has no right to demand. A trust may have a crore of rupee lying, and a beneficiary who is part of a discretionary trust cannot compel the trustee to say that please distribute that to me. The only exception is that of a bare trust. When you have only a single beneficiary, right, then the concept of discretionary trust is useless because everything belongs to that single beneficiary. And under a bare trust, irrespective of what is written in the trust deed, a single beneficiary can demand the trustee to liquidate the trust and pass over the asset to him because the purpose is solved. And therefore, people always ensure that there are always more than one beneficiary so that the beneficiaries do not get a right to kind of, direct the trustees to part away with the assets. But subject to this more than one beneficiary rule, these beneficiaries in a discretionary trust will have no right, no authority to compel a trustee to give back a part of the assets or part of the income. Of course, the beneficiaries can still hold the trustees responsible to follow the charter of the trustee. And let me give you a couple of examples. Let us say the trust deed says that the trust will not remunerate the trustees in any manner. And the trustees, for any reason, start paying themselves a compensation. The beneficiaries who are beneficiaries of a discretionary trust can still stop the trustees from doing that, saying that you are going against the charter of the trustees. Let us say the charter of the trustee says that they can't invest in Bitcoin, in cryptocurrencies, in high risk instruments. And the trustee says that, hey, the market is booming, let us invest there. The beneficiaries can compel the trustee to withdraw those investments. And if any loss is suffered, they can compel the trustee to personally kind of compensate the trust. So the trustees are responsible to the beneficiary in a discretionary trust. The only power they have is whom to give what benefit is to the discretion of the trustee. Can you create in a discretionary trust certain compulsions such as regular distributions for living expenditure, meeting your education expenses, meeting your medical expenses, meeting your marriage expenses? Answer is yes. And in many of the trust deeds, they have a very standard template way of ensuring that the beneficiaries, do maintain a standard lifestyle. But yes, not necessarily that those beneficiaries are given a particular share in the whole trust deed. Now, how do you create a trust? You just get a stamp paper. So let's say I want to contribute 100 rupees, right? The stamp duty in Maharashtra is 2%. So of course you can't get a stamp paper for 2 rupees. So you'll get the minimum stamp paper, which is 200 rupees. And on that, you will draft your trust deed as a settler. The trustee will say, I accept the responsibility. So there will be two signatories. One is that of a settler, one is that of a trustee. There will be witnesses, but beneficiaries do not have to sign that trustee. Moment you sign that document, your trust has got created. You don't have to go to a regulator to create a trust. Once you create a trust, you apply for a PAN, you open a bank account, you open a demat account. That's it. You maintain accounts. There is no requirement of any compulsory audit. You may still do it for better governance, and you keep on filing tax returns on a year-to-year basis. This is it. No other procedure, no other filings, no regulators involved. It's as simple to create a private trust. Let me pause here. I see few questions in the chat box. I think there is a question from Anush Kumar. He's asking, can a corporate entity be a beneficiary of a trust? Legally, yes. There are challenges in Income Tax Act. The income tax challenges that a couple of years back, Section 56 was amended, which said that if you create a trust where there is a non-relative and they have defined a restricted set of relatives, which are all natural persons, then the donation or the contribution to the trust becomes taxable under 56. It's still a matter of debate. Is it really taxable? Like if you ask me my personal view, on first principle, you cannot tax a trust because the money is never received by the beneficiary. It is always received by the trustee. And even if the trust has a corporate beneficiary, there is no way the trustee could be said to have received that without consideration, because trustees are receiving it in a representative capacity. And therefore, even if you pay 100 crore to a trustee in a trust where there are non-relatives as beneficiaries, I believe the correct legal view is that the trustee cannot be said to have received those funds without consideration, because there is a consequent promise that I will utilize these funds for the benefit of the beneficiary. But today nobody wants to take any risk. So today a safer way is that forget the litigation, forget the technical argument. Just ensure that in your private trust you do not have any non-relative, which practically means that I cannot, even if it's my own corporate, even if it's the corporate of my relatives, I cannot create a trust with corporate as the beneficiary. But legally, I would say forget the tax implications. I will fight it out. Is it permitted under the Indian Trust Act? Answer is absolutely yes, you can do it. Second question is, can we transfer the assets by way of a will, by which Section 56 can be averted? Yes, this is possible. If you create a will and any assets have been transferred via a will, then arguably the specific laws apply. So there are certain exemptions, and one of the exemption is any transfer of property under a will. In that case, in my view, clearly the exposure becomes far, far less. There is a second question where Vijayji is saying the trustee cannot be the beneficiary. No, Vijayji. In most cases, we have seen the trustees also becoming the beneficiaries in most cases. So there is no such compulsion that the trustees cannot be the beneficiaries. Under the Indian Trust Act, it's absolutely fine. The only restriction is that if the settler wants to become the beneficiary, the settler cannot be the only beneficiary. There has to be another beneficiary along with the settler. That's the only compulsion. But if, let's say, a trustee wants to become a beneficiary, that's absolutely fine. He can actually be the sole beneficiary, provided the settler is somebody else. There is a question by Sambhav. He's saying, post creation of trust, whether any other person can also become settler by settling certain assets. This is a very interesting question, Sambhav. And if you look at the concept of settler internationally, they take a view that any subsequent donor is also a settler, right? And which I think is in substance the correct view. I don't think in practice we regard these people as settlers, in India. We just call them as donors. But I think in substance they are settlers. every subsequent donor, in substance, they are settlers per se. They are effectively adopting the trust deed created by the first settler, acting as donors and putting subsequent funds in that per se. But in general parlance, if you go to, let's say, an international trustee say that, hey, I want to create a trust, they will ask for all subsequent donors and they will characterize that in the group of settlers per se. Again, a question from Vijay ji: can an original trustee add more trustees? If the powers are given to the original trustee, if the powers are not given in the trust deed to the original trustees, then the trustee cannot add any further trustees. In most cases, you will see that there will be some succession of trustee clauses, whereby how would new trustees be added, removed. There would be a detailed exposition of that. So it's absolutely possible to give the powers to the original trustees, whereby they can keep on adding new trustees. And you just need an amendment deed. That is it. No rocket science. There is a question from Aarti. Her question is, in case of voluntary registration of private trust, how and where is the registration done? Yes, first of all, your comment is right. A registration of a private trust is always voluntary. It's not compulsory, unless your settlement is actually of a real estate. And I'll give an example. I can create a private trust by putting in 10,000 rupees, no registration required. I can still go to the local registrar and get my private trust deed registered. And candidly, there is no benefit. In fact, I would risk that my trust deed is lying in public domain. Somebody can go and access it. But if you still want to register it, you have to go to the normal registrar. But instead of putting in 10,000 rupees, let's say I put my residential property into the trust deed as the first asset by which the trust gets created. Then my trust deed compulsorily requires a registration, because this effectively is like a conveyance, where under the Transfer of Property Act, read with the Registration Act, I have no choice but to register the original trustee. And therefore, in most cases, even when families wish to transfer their immovable property, the way they do it is that first they create a trust with a small sum of money, which does not require registration. Then they create a subsequent gift deed to gift that immovable property, and it is only the gift deed which requires registration. There is a question from CPC Pune, I think it's Sachin, as to who is the protector, whether his role is different. And there is a slide which I'll deal with, Sachin. Protector, the concept of protector is there in many international trust laws. It's not there in India, and yet you see the concept of protector being adopted. This is interesting. In the Indian context, you rarely require a protector. You definitely require a protector if you're creating an offshore trust. And I've kept one slide where we will be talking about how do you create a foreign trust per se, where this role of protector becomes really important. Nikunj says whether beneficiaries can be added, deleted. Answer is yes. It's absolutely depending on what rules of addition of beneficiaries and what rules of deletion of beneficiaries have you created. What would be the validity of the trust in case of death of all trustees and all beneficiaries? See, the trust doesn't end merely because the trustees die, because somebody would replace them. But if all the beneficiaries die, then depending on the relevant succession law, the property devolves on them. So let's say you have created a trust with beneficiary A and beneficiary B. The trust deed does not talk about who will replace them, right? And unfortunately, both A and B expire, let's say in a plane crash. And let's say they are Hindus. I'm giving a more simplistic example. They can be of any religion. Then the Hindu Succession Act applies. It is as if though their beneficial interest where they are private property and they have died intestate, which means they have died without a will. If they have a will, then the properties go as per the will, which means the beneficial interest gets transferred. And let's say if A and B say that after us, everything belongs to C and D. Let's say they have created a will. Then C and D actually become beneficial because the beneficial interest have got transferred to C and D. So it would then depend on the will and the relevant succession law, which is applicable to the beneficiaries. There is a question from Deepak: in whose hands will income of the trust be taxed? What I'll do, there are a couple of slides on taxation. I'll actually come to it before we answer this. Why don't I pause here? There are too many questions. So let me come back to the slide, and I'll probably, start with the question posed by Nikunj after some time, where he's talking about some interesting NBFC issue per se. So, what are the benefits of a trust? Uh, I think the benefits are immense. You can have a clear segregation of control and ownership, right? Let's say I have, 5 children. 2 children are not in the business. 3 children are in the business, right? I can shift my business in a trust, make the 3 children who are actually running the business as the trustee, but still give benefit to the balance 2 children. So I can have clear segregation of control and ownership. So I can give benefits to somebody without giving them any power of control or influence. And I can give control to somebody. And if I decide that person controlling may not have the benefit. So I can design my own framework of control and benefits. Smooth transition of management. See, compared to a will, where sometimes disputes happen, you have to go and take a probate. Sometimes it takes almost a year to get a probate. Succession under the trust is far more smoother. People are preferring, therefore, the trust framework more and more compared to the will framework. Facilitate clear line of succession. I think it's a subset of the point which I just mentioned, that if you have created a succession of trustees in your trust deeds, it can hardly be disputed, unlike a will. Let's say maintaining recognized family interest. There are multiple families, 3 families coming together, doing a business. Each family has now second generation, third generation. The branches keep on increasing. And if, let's say, the share of each of the families is 1/3, 1/3, 1/3, you can create Chinese walls via 3 trusts, where now the new generations play within that one basket of trust. The second generation, the third generation of the second family member create and play in the second basket of second trust, and so is the third. So I think you can create clear bifurcation between families, and you can recognize the family interest and create a clear bar about it. Regulation on third party entry into family business. You can actually create clauses in the trust deed saying, sorry, my son-in-law or my daughter-in-law, let's say for the first 20 years will not become beneficiaries, will not participate in the business, will not take any decisions. You can create some of these clauses if you think it suits your purpose. Planning for inheritance taxes. Obviously, I don't think the purpose of today's session is to talk about a law which is still not there today. But yes, people are anticipating that one day, now whether it's 5 years, it's 50 years, nobody knows. One day, if an estate duty comes, then maybe their best chance is creation of a private trust to save themselves from an estate duty. This is a very simple comparison between trust and the will, and I don't want to get into it, but effectively, the biggest advantage of a trust is that a trust is a sophisticated will. There is no difference between a will and a trust. All your wishes, everything, what you want to do it in a will, you please do it in a more structured way in a trust. And you can obviously, like a will, keep on changing your trust deed as and when you want. There are certain legal advantages. You don't need a probate. Very difficult to challenge a trust, unlike a will. And yes, a will normally does not give any protection against an estate duty. A trust gives a protection against an estate duty if the law comes. The only advantage of a will over a trust is that any property transferred under a will normally does not attract a stamp duty. But if you create a trust today, put your house, put your farmhouse, you have to pay a stamp duty. So the only disadvantage of a trust over a will is the immediate payment of the stamp duty. Rest, you would see trust being a superior vehicle compared to a will. I think we have spoken about who can create a trust, etc. This is a very important framework, and Parth, once again, thanks a lot for putting this together. But it gives a bird's eye view that how a trust deed is to be drafted. And I would caution you, do not take a standard template. It's too dangerous. We have advised families, we have looked into certain trust deeds created a couple of decades back. Some standard template created, and they forgot to give powers to add future beneficiaries. Forgot to give powers to trustees to amend. lot of clauses missing, and it's a complete mess. So a trust deed has to be thought through, customized to the family, and it's only after many, many months of discussions that one should start attempt to drafting it. You pick a standard template, you get a wealth manager, he says, I'm giving you this template, go and execute a trust deed. You will miss out on something. It's very, very dangerous. Now, what does a trust deed has in terms of content? One is the trustees and trustee lineage. I think as Vijayji asked the question that can an original trustee appoint, future trustees? Answer is yes. Can I make beneficiaries appoint future trustees? Answer is also yes. So you think through, how will your trustee succession happen? Today you have appointed two trustees. What if they are no longer there? Who needs to replace them? How would you select and how would you appoint new trustees? What if there are disputes between current trustees as to how do we appoint a trustee? Will it be the majority rule? Will it be the unanimous rule? Will it be the veto rule? There are multiple rules, which we apply when we draft a trustee. Second is again defining beneficiaries in advance. Whom do you want to have beneficiaries? Keeping the income tax condition in mind that only close relatives can be beneficiaries. And I've picked a very interesting case study at the fag end, of uncle and niece. And unlike popular perception, there are immense complications whenever you have a cross, uncle niece or uncle nephew scenario. What if the ex-beneficiary is married tomorrow? Will the spouse be a beneficiary? Will the grandchildren be a beneficiary? What if there are divorces? If you have included the spouse, will they automatically get removed? There are so many permutations and combinations, So you have to think a lot. What are the powers of the trustee? Is it like every trustee gets 1 unit of power? Is it that there is a managing trustee above other trustees? Is it that one trustee has a veto on certain things? Is it that you have divided between two trustees? One set of trustees look after business, other set of trustees look after treasury, investment, savings. Again, every family will have their own views as to how do they function. So I think what is most important is creating a scenario building, debating it for months, and then starting and drafting a trust deed. But this is broadly, I would say, a very basic framework of how a trust deed looks like. This is the offshore trust. There was a question, and the way you create a trust in India, you can also create an offshore trust, where the offshore trust can actually hold your international companies, your international business. The challenge is that my personal view is that it is very difficult to create a trust sitting in India. So I can become a settler of an Indian trust where all my beneficiaries are sitting in India. But I cannot become settler of a foreign trust where at least one of the beneficiaries is sitting in India. I have seen many people creating that, but that seems to be prohibited under LRS because they say that under LRS, you cannot put any money out for the benefit of any Indian resident. But if let's say all your beneficiaries are residing abroad, can you settle a trust, a foreign trust sitting in India? That's absolutely fine because that's tantamount to a gift. But if you have certain non-resident family members abroad, we advise them that that's the best opportunity to create an offshore trust for members sitting in India. The way the concept, the way the framework applies to an Indian trust, absolutely the same concept applies to an offshore trust. And if you look at generally the trust laws, of multiple countries, almost 80 to 90% is common. There would be differences only in certain respects. For example, in Singapore, if you create a trust, the trust cannot be beyond 99 years. If you create a certain category of trust in Cayman, there is a limitation of 200 years. If you create certain categories of trust in certain other European countries, it could have perpetuity. So it will depend, law to law. But the concepts of a trust remain. Everywhere you have a concept of a settler, you have a concept of a trustee, and you have a concept of a beneficiary. Now, in this question, I think Sachin had raised this concept of a protector. And many trusts have this concept of a protector, which finds no mention under the Indian Trust Act. But simply speaking, a protector is a supervisory person over a trustee. So he is like a super monitor. If a trustee is a monitor, then you are putting somebody above him to evaluate that, is the trustee doing his job or not. And therefore, the role of a settler normally is to just ensure that the trustee is doing the right thing. the protector will never ever decide what a trustee needs to be done, but a protector will normally have a power to remove the trustee. And in this case, you normally see that whenever you create foreign trusts where you can't have trustees sitting in India because of exposures to tax, place of effective management, and other things, you would normally make somebody sitting in India as a protector, so that tomorrow, if that overseas trustee goes wrong, then the protector sitting in India can immediately remove that trustee and appoint a new trustee. So that's basically the concept of a protector. He's like a super trustee per se. Let me skip this slide. This is just a broad flavor of how our inheritance tax law was. And the only thing I wish to say is that before it was removed in 85, the maximum rate was 85%. So if you leave behind a wealth of 100 crore for your successors, in the 80s, 85 crore was taken away by the government and 15 crore was left, maybe for partying and all that. I don't expect such a high rate of estate duty ever to come back. Our estate duty rate could be anywhere between 20 to 30%, the headline rate, if at all it comes. But obviously the erstwhile estate duty rate was draconian. Now, let's talk a bit about taxation of discretionary trust. And the first question, what is the status of a trust? The fundamental rule is that the status of a trust is derived from the status of the beneficiary. And let's take few simple cases, because today in an Indian context, you cannot create a private trust with non-individuals because of the tax exposure under Section 56. So let us say you have created a trust with all beneficiaries being close relatives and individuals, which means that the status of all the beneficiaries is that of individuals. In this way, the status of a trust also would be that of an individual entity per se. Now, if you have a discretionary trust, which means the shares of the beneficiaries are not defined, then typically the income of the trust is taxed at the MMR, the maximum marginal rate, the highest rate. And there are some issues around the MMR, the surcharge, which we will cover it in some time. If any income is earned by the trust, which is taxed at a specific rate, let's say you earn a capital gains tax, right? Long-term capital gains tax is taxed at 10% plus relevant surcharge. Then the MMR doesn't apply. The better view is that the special rate still overrides the general rule of MMR. If dividends are taxed at X rate, the special rule still overrides the general rule of MMR. If certain income is exempt, then that income will continue to be exempt, notwithstanding the fact that generally the trust is taxed at MMR. Once the trust receives the income, the trust pays the income, and thereafter the trust discharges the tax. After that, any distribution made by the trust to the beneficiaries, that is something which is not taxable once again in the hands of the individual. Again, as we discussed, any contribution made to the trust created solely for the benefit of relatives, again, is not taxable under Section 56. This is a brief table I have given. We need not, get into it right now in detail. Probably you can refer it. But effectively, the debate is that, do I get the benefit of slabs under a trust? Do I at all get the benefit of a slabs? And apparently, only if you create a child trust, and this is the only trust created for the child, and there is no business income in it, you have some chance of creating and getting some slab benefit. Else you are unlikely to get a slab benefit, presuming all the beneficiaries are taxed in the highest bracket. That's the sum and summary. But whether it's a specific trust or it's a discretionary trust, the concept is same, that status is that of an individual, and it will be subject to tax as an individual person. Certain very interesting issues. Let's say I'm a tax officer, and let's say there is a private trust which has filed a return. I don't want to pass an assessment order on the private trust. I want to pass an order on the ultimate beneficiaries, right? Can I do that? Answer is absolutely yes. Under Section 166, there is a discretionary power on the tax officer to assess either the trust or directly the beneficiaries. However, the quantum of taxes do not change, whether the trust is assessed or the beneficiary is assessed. And hence, that's one of the reasons the tax office normally do not have a motivation to trigger their powers under Section 166. They are happy to assess, the return of the trust. But can they go behind the beneficiary and assess them? Answer is yes. Second question, for MMR, see, as we know, our surcharges are super. It's like if your income is above 5 crore, you have to pay a surcharge of 37%. Let us say there are individuals, all the individual beneficiaries in their personal return, they are having income of above 5 crore. Then they have a trust where they are all beneficiaries, and the trust has earned an income of 1 crore. Because the trust is assessed in the same and like manner as a beneficiary, can the tax office say that, hey, effectively this income is that of the beneficiary, I have the power to assess the beneficiary directly, and therefore even if I'm assessing the trust, I'm going to apply the surcharge of 37% on the trust, and not a surcharge of single digit percentage. Is that possible? If you ask me my personal view, I think it's absolutely possible. I think that is actually the better view, that even the trust has an income just of 1 crore, the tax office can actually levy a surcharge of 37%. Interestingly, you actually have a positive decision of a Hyderabad tribunal, which seems to indicate that no, just look at the income of the trust, don't look at the income of its beneficiary. And also, when you file the return, interestingly, the return does not allow you to offer a tax at a higher rate. So today, the returns which are there, you put in an income of 1 crore and you attempt to pay a surcharge of 37%, it is not allowing electronically. So today, it seems the general practice is that do not look at the income of the beneficiary, look at the income of maybe just the trust. And if the income of the trust is less than 2 crore, less than 5 crore, then these super surcharges do not apply. Is that a law? I think that's a matter of question. We already discussed that while a discretionary trust could be subject to tax at MMR, we have to respect the special rates. We have to respect exemption. We have to respect 10% capital gains tax rate. We have to respect 20% capital gains tax rate. I do not think that changes, and that's a better view. Do discretionary trusts get access to basic exemption limit? Answer is no. The only scenario I mentioned is when none of the beneficiaries are subject to tax, and basically you have created some kind of a child care trust, which are far and few. Can a trust avail in concept deduction under ATC, 54F, 54EC? Why not? The status is of an individual, and there are certain tribunal decisions which is absolutely a trust can avail some of these exemptions, because these exemptions are available to individuals, and the status of trust is also that of an individual. Some comments, two comments I want to make here is, one is the character of the income which the trust distributes it back to the beneficiary remains the same. Which means if a trust has received share of profit, which is exempt, when the trust distributes it back to the beneficiary, it retains the same character. It cannot be taxed, because the underlying nature was that of an exempt income. Similarly, technically, let's say there's a specific trust. I'm taking a more simple case. A and B are 50-50% beneficiaries. The trust makes a capital loss of 5 lakh rupees, right? Can A say that 2.5 lakh loss belongs to me and in my personal return I will adjust? And can B say that 2.5 crore loss also belongs to me, the balance 50%, and in my personal return I would adjust? I think looking at the way the scheme of taxation is drafted under 161, I think fundamentally this is possible. How would you explain to a tax office? How would you put it in a tax return? That's a practical challenge. But purely looking at the law, this seems to be possible, that you shift the loss in your personal return for the purposes of set-off where you are a beneficiary. But this becomes more difficult if you're a beneficiary in a discretionary trust, because you do not know what is your share of income or loss. But in case of a specific trust, this is more easier said. It's quite implementable. Let me pause here and, before we go to the FEMA and the SEBI and all, why don't I again go through the set of, few questions. I think I have to start with the Nikunj. Just a minute. Sorry, there are so many questions. I'm slightly lost. Yeah, I got it. Yeah. So the question by Nikunj is whether for a trust involved in investment activity, NBFC issue can crop up. Answer is no. Most of the private trust, they do a lot of investment. And the reason why I believe NBFC issue cannot crop up, because if you look at section 45I of the RBI Act, which defines what an NBFC is, it only governs a company, not a private trust. So I do not think NBFC issue is an issue here. Securities or instruments in which a trust can invest, etc., etc. This is very interesting. So normally when a trust deed is drafted, we specifically write that the trust deed overrides section 20 of the Indian Trust Act, because section 20 of the Indian Trust Act creates certain limitations as to which all instruments you can invest. Of course, this is subject to the trust deed permitting it. That's the way the section is constructed. So as long as the manner in which you draft the trust deed permits all these investments, this is perfectly fine. There is a question from Mansi whether clubbing provisions would be attracted where the beneficiary is either spouse, son's wife, or minor. I think it's a very good question. And the answer is yes. Merely because you create a trust, for the benefit of, let's say, your wife, you're not able to obviate the clubbing provision. So the exposure of clubbing provision also remains typically under what you call a private trust. The manner in which we attempt to remove that exposure is by sometimes creating a investment entity under the trust. So let us say you put the money in the trust puts it into an LLP, and the LLP is earning an income. In that case, very technically, the clubbing provisions do not apply. And then when the LLP's funds are withdrawn as share of profit, clubbing provisions are meaningless because anyhow that share of profit is exempt. So there is exposure of clubbing. Care has to be taken vis-a-vis this clubbing, but there are ways in which you would manage the clubbing exposure. Whether income tax on the income earned by a specific private trust should be paid under trust pen or trustee's pen or beneficiary's pen. So while trust is not a legal entity, as a practice, trust do get a pen. Trustee doesn't have a separate pen. Trustee will have his personal pen, but trust will have his pen, and you need to pay the tax under the trust pen, not under the beneficiary pen. What if the sole trustee dies in a discretionary, non-discretionary trust? You have to go back to the trust deed and check who is the successor. But if the trust deed is silent, then normally all the beneficiaries can come together and appoint a new trustee. Again, one question from Mohammed is whether can an author settler can settle income from property in favor of a trust. You can settle an income from property in favor of a trust, but it can't be a contingent income. So you can't say that, I would get some rent income in future, and that income I'm settling into the trust. That is not possible. So if you wish to do that, the way you have to do it is that you have to first create a trust with a property which is in existence. Once you shift a property, let's say 100 rupees, in a trust which is in existence, you then create an agreement which says all my future income will be shifted to the trust. That is possible. But for creation of a trust, you cannot have contingent income. You need to put an existing property to the trust. Sharad Bhai, question is your views on same person is settler, one of the trustees and one of the beneficiaries. It's absolutely legal. It absolutely happens, in practice many times. Not a problem at all. Manish's question is, can an NRI be beneficiary, trustee, etc.? Okay, great. This is the slide. So, Manish, I will deal with that in the next few minutes. So let me ignore these questions. Whether settler becoming a beneficiary, will it fall in deemed revocable trust? Answer is absolutely yes. If I create a trust, I am the settler and I am the beneficiary. irrespective of what that trust is under the trust law. From an income tax perspective, section 60 to 63 gets hit, and this is regarded as a revocable trust, which means all the income of the trust is deemed to be my income as the settler, and I need to pay tax per se. So that's absolutely right, Sharad bhai. The next question is how distribution of immobile property is possible among the beneficiary. It depends on the trust deed, how you draft it and how you want to do it. Per se. Can trustee be a beneficiary also? Yes, we already spoke. Our answer is yes. Lakshmi Chandbai's question is what happens when all the beneficiaries of the trust no longer exist? I think I answered them. Lakshmi Chandbai, finally, it will then devolve on the successors of the beneficiaries as per the relevant succession act applicable to them, depending on their religion. Per se. Can more beneficiary be added post the creation of the trust? Answer is yes. Normally, we do insist to draft such a clause. How the changes in the shares get effected in case of death of one of the beneficiaries, it is always provided for. So the trust deed has to be very properly drafted, as to how the shares would get changed, etc. Will the change happen proportionate to the share of the demising, beneficiary, etc. But normally it's good to clarify that. Next question, is it possible to amend even the original trust deed in the absence of any specific power in the original trust deed? It's a very interesting question, and the answer is it's not that easy. If the settler is alive, it is pretty easy to do it with the consent of all the beneficiaries. But problem is if the settler is not alive, there are two schools of thought. One school of thought is you approach a court under the specific relief act and get this deed changed. And another school of thought is that if the settler is not alive, as long as you are sticking to the spirit, to the whole objective of the trust deed, the beneficiaries and the trustees taken together can go and amend that trust deed. So depending on the councils, people take one of the approaches. But if the settler is alive, far easier to do it. If the settler is not alive, you obviously need to take, one of the two legal views which are currently in vogue. From tax and liquidity view, which is better, trust versus LLP versus company versus partnership? I think very difficult to answer. The facts will have to be taken care of. And I'll give you an example. You can always create a LLP under the trust because super surcharge does not apply to LLP. So many times when you have significant investment income coming, it's better not to take that income in the trust. It's better to take that income in the LLP. You have certain practical challenges because RBI cannot govern an LLP. So there is a kind of an informal diktat given to the MCA that if you find an LLP doing only investment activity, please discourage them and tell them to wind up. A couple of our clients have got such notices. But preferably you need a vehicle under the trust to avoid those super surcharges. Now, whether LLP is better, company is better, that depends on your objective. If your objective is to upstream the funds up, then definitely company is costly because while the rate of company is 25%, upstreaming costs you further tax cost, which is not there in an LLP. So while an LLP gets taxed at 34%, share of profit taken out is absolutely exempt. So it's your objective. If your objective is to never take out majority of the income, company is good. You obviously will then need to take care of the NBFC and all that issues. But if your objective is that no, regularly I would love to take the income out, then LLP is of course a far better vehicle. LLP versus partnership from an income tax perspective, it's absolutely the same. A partnership does not give you a limited liability protection, but then you may come back to say that the nature of my activity does not even need such a protection. So I may rather choose a partnership rather than an LLP. So there are some of these factors which you will take into account. Mansi's question is whether MMR would be levied on, let's say, capital gains. Answer is no. The better view is it should not. The special rates of capital gains should apply. Another question, how can a private trust with money as the only trust property be dissolved? So the power of dissolution needs to be given in the trust. So when you draft a trust, you need to carefully think through a scenario which gives the flexibility to the beneficiaries and trustees to dissolve it. If you don't have that power, it is very difficult to dissolve a trust. And again, somebody asked a question that how do I change the trust deed? You'll have to first change the trust deed and then dissolve the trust. Can beneficiary assign his interest? If the trust deed permits it, you can actually assign your interest in the manner in which you want. So it depends on what you write in the trust deed. Normally, as a practice, we advise clients that do not allow beneficiaries to assign their interest normally. So, the thumb rule is prohibit such an assignment of interest. But if you, for any specific reason, wish to allow the beneficiaries, you can always do it. Girish Bhai's question is, trust deed allows to add, remove beneficiaries. Would it be a valid trust? Yes. If the settler has given that power to the trustee, then that's absolutely fine. Because then really the trustee is acting in accordance with the trust framework created by the settler. So that should be valid, Girish, right? If no clause to add, remove beneficiaries and trustees add new beneficiaries, is it valid? I agree, this is not valid. If the trust deed is not giving the power to the trustees to remove it, you cannot add it. And whether any implication on trust existence, the action of adding the beneficiary is illegal. The trustees could be personally held liable for any share given to such illegal beneficiaries per se. But per se, the trust does not become illegal per se. Rohit's question is, what would be tax implications if distribution in second year? No, so if the trust has paid the tax, you can distribute in the same year or future year. There cannot be a double tax on that per se. Master trust created for benefit of multiple child trust for the benefit of close members, but no individual beneficiary in master trust. Is it okay? Good question. I've read some absurd opinions saying that this is a big exposure. I don't think it's right. A master trust, subtrust, and individual structure is absolutely fine from a Section 56 perspective, because the subtrusts are not legal entities. If you are put in companies, a company is a person, but subtrusts are not legal entities. Effectively, they are the ultimate beneficiary. So the status of subtrust also would that be of an individual. So I would like to believe it is perfectly fine. And there are many structures which have been implemented on this count. Mohammad's question, how can we get copy of the PPT? I'm presuming they will circulate it. So I'll share the copy with the organizers. Applicability of accounting standards in case of investment trust, whether various expenses incurred by investment trust, such as salaries, management fees, and other expenses. And it's a very complicated question, Manish. Two comments I'll make. Trust have to follow accounting standard, because accounting standards apply to enterprises. And if the trust is doing what we call a regular investment activity, it will fall within that definition. The question of how do you allocate expense is a very complicated question. Is it at all deductible, not deductible? So I think we'll take this offline per se. Next question is, it's the same. Can a trust be a partner in LLP? Answer is yes. It's a very good question. I have a case study here. So Mr. Shah will wait for that case study, where I believe that it is possible to make a trust a partner in the LLP. But let's discuss that in the case study. Ashok's question, if there is only one beneficiary, is it required to take separate pen for the trust and file tax return? Yes, you still have to do it, irrespective of the number of beneficiaries. The moment you create a trust, the trustees will kind of obtain a pen for the trust, and the trust will have to file the return via its trustees, but using its own pen on a year-to-year basis. Which ITR form to be used for filing trust return? I don't have the ITR number, but I think it's ITR 5. It's actually written for private discretionary trust. It's a special return. Mansi, here one very interesting issue is when you file that return, it says that this applies only to AOP. And we just discussed that a private trust need not be an AOP because the underlying beneficiaries are individuals. In that context, a couple of years back, CBDT had issued a circular clarifying that do not go by the title of the form. If the underlying status is that of an individual, the trust will be assessed as an individual. So there is a bit of a dichotomy in what that form says and what the actual legal status is. Deepak Doshi, how can loss incurred by a specific private trust be claimed by the beneficiary, since the loss will have to be taken in trust income tax return? It's a very good question, but Deepak, fundamentally the trust is not a person at all. So let's say I have created a company incurs a loss, right? I cannot say that's my loss because I am separate, my company is separate. But a trust is not a separate legal entity. That's one of the reasons you do not find the word trust in the list of assessees. You go to section 2, subsection 31. It talks about individual, HUF, firm, company, AOP, BOI, artificial juridical person. It does not talk about trust. Now you come to section 161, 160, sorry, the section of representative assessee. Again, it says that trustees shall on behalf of the beneficiaries file a return. So it's very interesting, but technically the trust is not filing a return. And then you look at the scheme of taxation, which says that the trust shall be assessed in the same and like manner as that of a beneficiary. So effectively, some of these provisions read with the landmark Supreme Court decision of Kamalini Khatau, they effectively say that the manner in which the legislature is trying to tax a trust is nothing but tax a beneficiary. And which is evident from section 166, because section 166 gives the power to completely ignore the assessment of a trust and directly tax the beneficiary. And in both cases, the numbers cannot change, your assessment numbers cannot change. And that is the reason why in a specific trust where you know that this much loss pertains to me, I believe fundamentally you do have an ability to take it. Now, in practice, is it that easy? We obviously know, the knowledge of trust is so scarce, and especially in tax office, people don't understand the fine points about it. So it's a huge challenge. Whenever somebody says, "Oh, I will then plan around it," and our question is that it might be good in law, but you will need a court to come and direct. The assessments are going to be very difficult. But under law, does it seem to be sustainable? My personal view is it's absolutely sustainable. Okay, we have questions from Sambhav. Is there a concept of frustration of trust? If yes, what are the circumstances under which a trust can be considered as frustrated? What I'll do, if possible, I'll pick it up in the case studies, Sambhav, and maybe narrate one or two examples about this. The next question is there any concept of expiry of trust? It will automatically dissolve under certain years. It's a beautiful question. There is a lifelong debate whether the law of perpetuity applies or does not apply. We have seen certain trusts which says that after 30 years, this year, the trust will be automatically dissolved. And this whole concept is because of certain provision under the TOPA, the Transfer of Property Act. Now, today, one overwhelming view is that, I will create a perpetual trust. So in most of the trust deeds, you see families and councils taking a view that I'm not going to create any automatic dissolution of the trust. Let it go for perpetuity. So that's the current practice. But this issue remains, Sandeep. And, my view is that, take a view tilting towards the fact that the trust could be perpetual, because you will see councils supporting that view. But is it a complete clean case? Answer is no. There's a question mark around it. Utsav question is, can HUF be entity below trust by way of capital contribution? No, Utsav, you cannot have HUF below the trust in any manner. You can only have HUF above the trust as a beneficiary. So can you have HUF as a beneficiary? Answer is yes. The only challenge is that under the definition of relative, the way they have drafted section 56, HUFs are to be ignored. And that's one of the reasons why you do not have any HUFs in current private trust. You will see HUFs in old trust, created prior to this amendment. But the current new trusts do not have HUFs as beneficiaries. Please explain how trust structure can be used for common investment of a large family. Mohammed will discuss that. But effectively, a trust does not give you any significant income tax benefit. It gives you certain protection against a future estate duty law, but more importantly, you are creating a family succession. You are creating a sophisticated will in a trust, and you are defining the rules of, how after the head of the family demising, will the members carry forward his wealth, his legacy, and his objectives per se. Let me touch upon the most vexed subject for which either there are no answers or there are multiple answers, but I'll also share how it happens in practice. So if you look at the first question, that let's say you have created a trust. How do you determine that the residency of this trust is in India, or it's a Indian resident trust, it's a non-resident trust? How do you determine that? And unfortunately, the FEMA provisions do not have enough, I would say, framework around it. I think they've never envisaged that there could be a trust, and hopefully one day I believe the government will come up with a very detailed framework. But today the Reserve Bank doesn't understand what a trust is. Today the banks do not understand what a trust is, which sometimes is an advantage, sometimes it's a disadvantage. If you look at the only provision, if my memory is right, section 2 says that an entity registered somewhere will be regarded as a resident where it is registered. So very theoretically, somebody asked a question that can I voluntarily register my private trust? You know, and if I were to extend it to its absurd interpretation, I would say yes, let's voluntarily register the private trust in India and let everybody be non-resident. Trustees be non-resident, beneficiaries be non-resident. And you try and argue before a banker because Reserve Bank doesn't meet you directly. You go through a very adulterate challenge, of authorized banks, and you argue before a banker saying that see, the law says in case of any other entity, the residency depends on the registration, and I've already registered it. I don't think that's the correct interpretation. When they say registration, they talk about something like an incorporation. They talk about something like a firm being registered where you get certain identity number, etc. This registration is a mere storekeeping activity per se. So I do not think merely because you register, you are getting into that condition. And interestingly, some banks say, oh, you are registered, you are an Indian trust. You are registered in Singapore, you're a foreign trust. You are registered in UK, you are a UK resident trust. That's not, I don't think that's the correct this thing. And it seems in the absence of enough guidance under Section 2 of FEMA, the correct view seems to be where the affairs of the trust is being managed. And therefore it depends really on the trustees. And if you have majority of the trustees who are outside India, there are two exposures. First exposure is under the Indian Trust Act, can you at all have a trustee outside India? And there are certain provisions which says that the beneficiary is given a right to kick out a trustee moment he is outside India. If the beneficiaries do not object, it seems it is valid. The second view is that if majority of a trust, majority of the trustees of a trust are resident outside India, then really your affairs are being conducted from outside India, unless you demonstrate that whenever decisions are being made, these trustees visit India and then take decisions. So the conduct of a trust becomes very important. And that is one of the reasons, one thumb rule, what I would say we advise our clients is that to the extent possible, it is not possible in every family. In some families, they say, sorry, there is no way I can have resident trustees because most of us are staying outside India. But to the extent possible, ensure that majority of your trustees are resident in India. Your case of then arguing that my trust is a resident is far better, I would say. Residency of a settler, irrelevant. Residency of a beneficiary, irrelevant from the perspective of, I would say, determining the residency of the trust person. So this is the current approach. Some banks have become mature enough where some banks are saying that, do you have more trustees in India and less trustees outside? If yes, we are comfortable with this structure, So this is an evolving subject where finally it depends on your authorized banker. Some bankers, as I mentioned, are very comfortable moment you do a voluntary registration. That's not the correct view, but they're accepting it, good for us. Some banks are becoming more mature. They are saying, where are the trustees functioning? And one indication of where are the trustees functioning is what is the residency of majority of the trustees. So this is probably an indicator. The second issue which arises in FEMA is, can I set up an Indian trust with non-resident beneficiaries? Let's say I am a resident, I am a settler, I have my daughter studying in USA, I have my son studying in UK, I have my parents staying abroad. These are all imaginary facts, we are all in India. But let us say if that is the case, can I really create a trust, make them beneficiaries? And if I strictly read the definition of capital account transaction, I am actually creating a beneficial interest in favor of a non-resident, which in my view is a capital account transaction, which in my view, moment I add a non-resident beneficiary, I need a prior RBI approval. That's my reading of the law in FEMA. Couple of years back, we used to very enthusiastically write to Reserve Bank that these are the provisions and we require your prior approval. And Reserve Bank used to say my approval is not required. And as in when you remit the funds abroad, please comply with the FEMA provisions or come to us. We were very happy. They were going contrary to our view, but they were actually taking a view which was suiting us, which is that my approval is not required. But they were taking a contrary view. They're saying my approval is required when you are sending the money out. Whereas interestingly, If I am already a beneficiary in a trust, then by virtue of that beneficial interest, those funds belong to me. Why do I need to go to Reserve Bank? It is like I need an approval to become a shareholder in a company. Let's say I need to comply with the FDI guidelines. But once I am a shareholder, the dividends are mine. They can't be there can't be any regulatory intervention. But the current practice is very interesting. The current practice is that Reserve Bank has stopped responding to such letters. So we have stopped writing to them. It is finally the authorized dealers. We tell the authorized dealer we are creating a trust with certain non-resident beneficiaries. Some authorized dealer are saying, hey, are everybody non-resident? Then wait a minute, I have concern. Some authorized dealer are saying majority non-resident, I have a concern. Some authorized dealer are saying that we are perfectly fine. As and when you take the funds out, you come to us. So there's a bit of a dichotomy in how things are functioning depending on the bank. Certain banks like HSBC, Kotak, Citibank, we have seen them to be a bit more mature. But if you go to some of the public sector banks, God knows, what stance they are taking. But today, are trusts being created with non-resident beneficiaries? Yes, but they are being done with some careful communication with the authorized dealer. That's how we are doing it. Any distribution of properties from the trust to the non-resident beneficiary, which in my view should not really require any intervention, but the regulators are taking a view that no, I will govern every distribution. Interestingly, there was also some representation made by BCA. Very well-intentioned representation, very nice questions. And the way the Reserve Bank responded was a total blooper, saying that, you please comply with the LRS limits, etc. So today it's a bit of a gray area that do I need to comply with the LRS limits if I create a trust? So the current practice is that, for example, we created a trust, we put in some 100 crore, and after a year, the father who was the settler basically transferred some 30 crore to his daughter's account via the trust. The banks permitted it. And from that, the daughter took out $1 million under the NRO route. The banks permitted it. Another bank came to say, sorry, we are not comfortable with this. You can only comply with the LRS limit. There cannot be a total fund outflow beyond $250,000 to all beneficiaries combined. So this is becoming a bit of a practical issue. So taking the money out is becoming a problem. It is like you find a convenient bank which is comfortable with the structure. But the first point, can I create a trust with non-resident beneficiaries and with some trustees as non-resident? Thankfully, most of the banks are pretty comfortable about it. Would it make a difference if the trust is specific or discretionary? It's not making any difference. Most of the trusts are anyhow discretionary. But even cases where we have created some trusts as specific trusts, it's not changing the current practice of creating a trust with non-resident trustees and beneficiaries. Can Indian residents set up a foreign trust with non-resident beneficiaries? Absolutely fine. This is like tantamount to a gift to a non-resident, which obviously will get covered under the LRS limits. Can an Indian resident settle his foreign assets not acquired out of funds held overseas in a foreign trust? This could be a challenge, especially if those foreign assets were acquired while he was a resident in India. But if those foreign assets were acquired when he was a non-resident, then this is absolutely fine, because under Section 5, the FEMA doesn't apply to such assets. Can non-residents be appointed as trustees? As I earlier mentioned, in most of the trusts where we have non-resident families, there is at least one non-resident trustee. There we attempt to take a care to ensure that the majority of the trustees are resident. Where it is not possible, we go and find a bank which accepts a structure where majority of the trustees are non-resident. Is there any restriction on residents from becoming beneficiaries of a foreign trust? There are no restrictions. The only restriction is this foreign trust cannot be created with money going from India under the LRS rule, because the LRS policy clearly says that it cannot benefit any other resident in India per se. So as long as the foreign trust is being created with money coming from outside India, I as an Indian resident, I can always become a beneficiary in that trust. I will then have to disclose that in my tax return. There is no disclosure provisions under the FEMA provisions, but what we normally do it is, as a best practice, we write to the authorized dealer saying that we wish to inform you that we are now a beneficiary in so and so foreign trust. SEBI, I'll very quickly just say one thing. Since 2017, there is a very detailed framework. So if I'm a promoter of a listed company, I hold the shares. I can transfer those shares to the trust subject to a SEBI approval. SEBI is taking a view that this triggers a takeover, under Regulation 4, read with 5, read with 6 under the takeover code, and hence you need to come to me under Regulation 11, make an application, and then we are happy to give an approval subject to all this. But SEBI is creating certain restrictions. It is not permitting a tiered structure. So one question of Sharad Bhai of a master trust and a sub trust above. Since almost 5 years, SEBI has stopped giving any approval. So we have not been able to get any approval of a tiered structure. SEBI is not permitting any corporate trustee. SEBI is not permitting any non-resident relative as a trustee. Not even one trustee can be outside the family. So there are significant restrictions which SEBI is putting in, which is creating, I would say, life interesting around this practice per se. But yes, today you are shifting your shareholding into a trust of a listed company. SEBI is taking a view, please come to me. I'll grant you an approval or dispensation under the takeover code. I think I'll not talk much about this care to be taken, but as I mentioned, don't use a template. I think creating a trust deed is like drawing a Picasso painting. Every painting will be different. You have to understand the ideology of the family. You have to deliberate on multiple scenarios. At some stage, you have to give your own experience to the family and talk about certain implications. I think this is it. You cannot have a locked trust. We had an occasion to deal with a client who had almost 20,000 crore assets in a trust, but the trust deed was very shabbily drafted, and there were a lot of anxiety periods, of couple of years before which they were able to amend that trust deed, to allow future beneficiaries, etc. So any trust deed which is shabbily drafted, which does not look at scenarios up to the third generation, I think at some stage in some decade you will face some challenges per se. So the trust deed has to be flexible. It has to, of course, toe with the family ideology. It needs to ensure that the guy who's giving away his wealth into the trust does not lose his control. That's very, very important. So I'll skip this slide because we may not be able to touch upon the case study. So let me take the first case study, and it's a very simple case study. I create a discretionary trust, which means on the date of creation of the trust deed, the beneficiaries are either unknown or the share of the beneficiaries are unknown. From an income tax perspective, this is clearly a discretionary trust. After a year, I finally make it specific. Under the Indian trust law, this is a specific trust, but question is, from an income tax perspective, will it now be regarded as a specific trust? The simple answer is no, because the provisions under 164 talks about the status as on the date of the trust deed, as on the creation of the date of the trust deed, which will be permanently attached to that trust. So you have no choice but to then dissolve and create a new trust with specific beneficiaries. Else, this trust will forever be regarded as a discretionary trust with its attendant implication of tax being charged at MMR percent. The second question, which I think Mr. J.K. Shah put in, can a trust become a partner in an LLP? Very interesting question. We still have some notices where we get queries from MCA that how is a trust a partner in an LLP? Because under the LLP Act, only a corporate body or an individual can become a partner. Obviously, in 2014, they had issued a circular saying that a corporate body represents a REIT or a AIF, and it can become a partner, because that's perfectly fine, because most of the funds are structured in the nature of a trust, and under the AIF regulations and thereafter under the REIT InvIT regulations, you can also float an LLP. And the issues were that the SEBI regulation is permitting a fund to invest in an LLP, but the LLP Act is creating an ambiguity, and the MCA came up with a clarification to say that no, the trustee of that AIF, which either will be an individual or a corporate body, is becoming a partner in an LLP. So this is absolutely in compliance with Section 5 of the LLP Act. But the circular was silent on the private trust. And in my view, absolutely the same analogy applies, that a trustee being an individual of a private trust can become a partner. So a trust via its trustee who is satisfying the characterization of being an individual or body corporate can become a partner in an LP. And I think even the councils are supporting this view. The problem is at times queries come from MC and then you have to deal with them and send them opinions and all that. But this is absolutely doable and it is already there in practice. And I think the last case study before which we just jump to the questions and close today's session is very interesting. Can an uncle give a gift directly to his nephew and niece? Answer is absolutely yes. Can an uncle create a trust where his niece and nephew are relatives? You will be surprised the answer is no. So the manner in which they have flipped the relative definition, a niece and nephew can create a trust for his or her uncle or aunt. Now, why would he do that? So apparently it's a drafting error, but today it's very clear that an uncle cannot create a trust in which a nephew or a niece is a beneficiary, but an uncle can gift, the shares directly, and it's vice versa. A nephew and niece cannot gift to his uncle or aunt directly, but they can definitely create a trust for the benefit of the uncle and aunt. So this seems to be an absolute drafting error, not rectified since many years. Until the rectification happens, I think this conundrum, would remain. I think with this, I think we have come to the end of the presentation. So what I would do it is, very quickly go through the questions. I don't know when was the last question. Just hold on. Yeah, this was the last question. I think I answered Mohammed on this trust structure. Arti's question is, can a trust deed have a clause on expiry of a trust? So can you create a trust with specific period, let's say 5 years, and then it expires? Answer is yes, absolutely possible. Manish's point, benefits of TDS in case of specific trust. Good question. There is one problem, one unnecessary litigation which has got created. There was a case of a trust which paid taxes, distributed the income to its beneficiaries. The assessing officer said that I will use my powers under 166 and directly assess the beneficiary. So beneficiary said, fine, you assess me, and the trust has paid certain taxes which effectively is paid on my behalf, and nothing more is payable my due. And the tax office said, no, that's paid under a separate pen. You are under a separate pen, so you have to repay the tax and the trust has to claim a refund. Absolute cash flow disaster. And apparently there is a tribunal decision accepting this, which in my view is with due respect, an incorrect decision. So there is this issue of lack of matching of TDS credit if the tax officer decides to kind of assess the beneficiaries directly under 166. I hope it does not spill over because it will completely discourage people from creating private trust. Then, sorry, where have I gone? In case of specific private trust having single beneficiary, in whose hands will the income of the trust be taxable, trust or beneficiary? The tax office can do whatever. The tax officer can say, I want to assess the trust, or the tax officer can say, I want to assess the beneficiary under 166. But the result should not change. Here, as I mentioned, the only issue is the tax paid by the trust should be given as a credit, because effectively the trustees are paying the tax on behalf of the beneficiary. Vijay Bhai's question is, I think it is not the trust that is registered, it is rather the trust deed that is registered. Yeah, it's the trust deed that is registered, and obviously it is optional. You're absolutely right. Legally there is no concept of a trust. It's a trust deed which gets registered, and that too, I would say 98% of the private trust deeds do not require registration. It's optional. The next question is, does setting up a private trust where settler and the trustees are Indian residents and beneficiaries are non-residents require RB approval? I just discussed this, so let me skip this question. In case of NRI being beneficiary, then whether FDI norms will become applicable? No, this doesn't come under FDI. Of course, the important point is that you cannot have a scenario where you have majority of the trustees and majority of the beneficiaries as non-resident, and this trust is investing in some sensitive sector, let's say telecom sector, right? Then that's a pure violation of norms. Having NRI trust in a gift city, would it be beneficial? And today there is no concept of having an NRI trust in a gift city. You can create a trust wherever it is, because there is no concept of a registration of a trust person. If the residential status of either the settler or the trustees or beneficiaries changes after setting up of trust, whether RBI approval is required, no, we just intimate the authorized dealer. So let's say you create a trust where everybody was a resident. One day, three members, domiciled outside India. You'll just inform the bank that, hey, I had created that trust. I am a non-resident, but there is no RBI approval required.